Okay, now we're going to move on and talk about your balance sheet. Did you know that most CPAs consider the balance sheet to be more important than the income statement? This is because the balance sheet gives a snapshot of the business's health at any given time. If your balance sheet is correct, it will tell you whether or not your business is healthy. Now, let's take a look at the Happy Kids Daycare balance sheet. First of all, you note that there's a date at the very top of the balance sheet. This means that all balances and transactions are accounted for up to midnight of that date. Then on the top line of the sheet, you have assets, and at the bottom, you have liability and owner's equity. The reason why it's called a balance sheet is that it has to balance. The formula for your balance sheet is assets equals liability plus owner's equity. An asset is anything that the business owns a value. This would include cash, building, land, autos, refundable deposits given to vendors or landlords, and prepaid expenses. A liability is anything that the business owes to others. This would include bills or taxes that need to be paid, credit card balances, and loans. Owner's equity, from a very simplistic standpoint, is the amount of cash you would receive if you sold the business for its assets and paid off all of your debt. If your equity is positive, it means the amount of assets you have is greater than the amount of debt you have. If your equity is negative, it means you have more debt than you have assets. Negative equity is not a good thing for multiple reasons. First, it signals to lenders that you can't withstand any more debt. The likelihood of getting a loan when your business equity is negative is slim. Second, if you have negative equity and distribute funds to yourself from the business, you will be subject to excess distribution tax. This is because you are paying yourself with money that the business borrowed and is responsible for repaying, meaning it's not yours to take. Now, let's take a look at some of the numbers for Alice at Happy Kids Daycare. We can see that Alice's total assets come to $686,200. Her total liabilities are $482,900, while her total equity is $203,300. Her total liabilities plus her total equity amounts to $686,200, meaning that her balance sheet is in balance. One thing to know is that while your income statement resets itself every period, your balance sheet does not. This means the net income on your income statement is entered into the balance sheet as retained earnings once the period has closed. And as I mentioned in the last lesson, your net income starts again at zero on your income statement at the beginning of the next period. Your balance sheet, on the other hand, never resets. It's based on all of your prior transactions, essentially from the beginning of your business. For this reason, the balance sheet tends to become messier than all your other financial statements, and that's why it's so important to review your balance sheet regularly to ensure that you understand every balance on the report. Now, let's go over some common errors we see on balance sheets. The first one I see often is missing refundable security deposits. For example, let's say you lease a new space for your childcare centre. You put down your refundable deposit plus your first month's rent, but you record everything as rent expense on your balance sheet, even though your deposit is refundable. Rent expense doesn't belong on the balance sheet. While it's not a big problem, it means that you have over-expensed your rent for that year. Later, when you get that refund back, you're going to have to reduce your rent expense by the corresponding amount. Another common error I see is missing depreciation. You'll need to calculate depreciation for your tax return, so you have to make sure that this amount also appears in your financial statements. Otherwise, your assets will be overstated. A third mistake I see is when people include small items as fixed assets. For example, we have seen several balance sheets where the business owner is including a $300 item as an asset. In general, if you purchase an item for less than $2,500, go ahead and record the purchase on your income statement and take the expense now, instead of trying to go through the process of depreciating the item on your tax return. Another error we see a lot is an incorrect loan balance being entered. This happens when a business owner sets up a loan on the balance sheet, and then when they pay the loan, they end up putting all the money up against the loan instead of putting part of it toward interest expense. This causes the loan balance and your expenses to be too low. The interest expense should go on the income statement. Finally, the last error we commonly see is when bank accounts and credit cards are not reconciled. To reconcile your accounts, you need to compare your business's financial records with those provided by your bank to make sure that they match up. Make sure that your bank and credit card balances, amounts you owe to federal and state governments, and any existing loan balances are all correct. It's a good idea to get into the habit of checking your balance sheet regularly so you can avoid these common mistakes. In the next lesson, we're going to look at the Happy Kids Daycare Statement of Cash Flows.